Now, we've spoken off and on about the IT space and specifically about the valuations as they stand right now. But right now, continued weakness and persistent global uncertainty has led to immense pressure on the IT sector. And this is not just over the last few weeks, it is the last few years, in fact. And this has led to IT valuations reaching near 5-year lows, with the current price to earnings trading lower than the last 5-year average. Is it a good time to look at this as a contra investment at this point? Because all things that go down eventually do move up, especially in the markets. Let's talk about this with Puneet. Puneet, is this something to consider?
Well, definitely. I think one of the key factors has been slowdown in earnings, and that's led to the valuation correcting in this particular time frame as well. But for IT space as a whole, we've seen that it's dropped to its lowest in the last 4 to 5 years, and that's led by earnings slowdown as well as lack of investment essentially in AI among other models. The other key aspect is for the valuations of Nifty IT now at 25 times price to earning is lower than its valuation of the last 2 years, as well as what it has been over the last 5 years, somewhere around 29 to 30 times. The total market cap for the Nifty IT is essentially down by 24%, and that is one of the key reasons why we are looking at this as well, to 24 lakh crore in this particular time frame. When you look at the stock price performance for the top 5 IT companies, we've seen roughly about 11 to 26% correction, with the highest being for someone like a TCS, which has been in focus on the back of numerous key negatives, to say the least, of reduction of workforce by 12,000 personnel amongst others, and that is one of the key ones. Mutual funds also, the ownership data shows very interesting trends. Over the last 3 to 4 years, we've seen a consistent selling by mutual funds in the IT space, and their weight in the IT sector right now is at its lowest at 7.76% than it has been over the last 4 to 5 years. This also is data of only the equity mutual funds, so across mid caps, large caps and small caps, as well as hybrids that invest only primarily in equity, shows this very interesting trend. Brokerages like Bank of America have now turned positive. We saw that note coming yesterday. They moved IT sector to an overweight from an underweight rating earlier, as well as mentioning that the 23% correction is a key positive. Someone like Elara has also mentioned that they are positive on IT and believe that the rupee weakness could benefit the IT sector as well. Finally, in terms of valuation as well as what brokerage makes it, valuations for TCS, Infosys as well as Wipro is lower than what it has been over the last 5 years. Of course, a lot of demand conditions have changed, and that reflects the current weakness in price to earnings, 18 to 22 times. For someone like an HCL take, it's similar to what it has been over the last 5 years. We've seen some correction from the 28 times it used to trade at. And for Tech Mahindra, post the new CEO appointment of Mohit Joshi, we are seeing the street give a little more weight to this one compared to the last 5 years. Finally, in terms of brokerages, we've seen TCS having almost the highest return potential, along with Wipro, 33-34 buy calls, while the rest indicate an 8 to 11% upside as well. So, a lot of news flows amongst others, but the earnings growth, as well as what happens with AI and the underinvestment by these companies, is one of the key reasons why we're seeing correction in this index over this particular time frame.